Alright, so in this video, we want to look at how to account for revenue. When you take the financial statement of every entity, revenue is one of the key um, items that investors or users of the financial statement look at. Revenue play a key role in the smooth running of the business. Most of the analysis that is done, most of the interpretations of financial statements are based on the revenue figure. For that matter, IFRS, in fact, the IASB has placed much importance on how entities determine their revenue. Previously, we used to have a standard, which is IAS 18, which talks about revenue. And then we have IAS 11, we talked about construction contract. Now, these two standards have been merged to form or to, establish a new standard, which is International Financial Reporting Standard 15, which says revenue from contract with customers, revenue from contract with customers. And this standard provides us with a comprehensive guidelines, comprehensive principles when an entity wants to account for revenue from contracts with customers. This lesson, our focus is going to be on that. As we have been doing, we are going to take it part by part, establishing the principles, understanding the principles, and solving practical questions under each situation. Alright, so starting from the scratch, we are going to look at the scope of the standard, the objective of the standard, and then we look at what the standard prescribes, the steps the standard prescribes in accounting from revenue from contracts with customers. Please do not forget to subscribe and share our videos with others so that we can increase the learning community. Alright. So, without wasting more time, what is the objective of the standard? Now, the objective of IFRS 15 is to provide enough information. To end users about the principles that will be used to determine the nature. So it's providing enough information to end users about the principles that is used in determining the nature, the amount, the timing, and the uncertainty of revenue and cash flow arising from contracts with customers. That is the basic objective of IFRS 15. Providing information that deals with the principles of the nature, the principles of the timing, the amount, and the uncertainty around revenue, and then cash flows arising from contracts with customers. Having understood the objective, what is then the scope? What and what does the standard cover? And what and what does the standard do not cover? In this lesson, or in this standard, the standard cover all contracts, okay? All contracts that is going to bring revenue. The standard cover all revenue from, contract with customers. The standard cover all revenue from contract with customers. So in case there is something like that, in case the entity is entering into a contract, okay, to provide goods to a customer, and in return is going to what? Receive considerations from the customer, then this is the standard we are supposed to, apply. Now let's look at some of the things that the standard do not cover. When we talk about lease contract has its own standard, that is IFRS 16. We also have insurance contract, which is also having its own standard, IFRS 17. We have sometimes we have these a contract that has to do with financial instrument. We have their standard, IAS 32, IFRS 9, IFRS 7. Now, there are some times where a party in the same business line, they exchange their products to satisfy their customers. So, for instance, let's assume that I'm entity A and then entity B. They all sell matter. If B is lacking matter and A is able to give B the matter, this is a non-monetary item, so that B can satisfy its customers. That is not that is not part of IFRS 15. This is not part of IFRS 15. So basically, this is the scope. Now, please take note. We only apply this standard when the revenue is from a contract with a customer. We only apply this standard when the revenue is from a contract with a customer. Now, the problem here is, what is revenue? What is contract? And who is a customer? All right. A revenue, we say that is an income that is arising from the day-to-day activities of the entity. Any income the entity generates from the day-to-day, from the output of the entity, that is what we are regarding here as revenue. Please be cautioned. For instance, if the entity does not sell a non-current asset, they use it for administrative purposes. And just one time they are selling off or they are disposing of that non-current asset. That amount, the proceeds they have gotten, is not revenue. Revenue here, we say they are the income from the day-to-day, what the entity does on a daily basis. The money they get, the consideration they get from those goods or the sale of, the provision of services, those revenue we get from that is what we are calling, or those income we get from that is what we are referring to as income. Once again, a contract, we say, is what? Is an agreement between two parties which comes or which gives rise to an enforceable right. So for us to say that we are going to recognize revenue, there must be a contract between the entity and the customer. And this contract should have an enforceable right that if one party fails to provide its side of the contract, then the other party can hold the breached party in contempt, or the party defaulting in the contract will be held liable. For us to say there's a contract, there must be what? An enforceable right. Now take note, situations where the parties to the contract, the entity and the customer have unilateral right in a termination of the contract, that is not a contract, because they can terminate the contract without suffering from any damages. So that is not a contract. Please, we only use this standard when the contract is with a customer, not with any other party. If the contract is with an investor, that is not, we are not applying this. If it is with a creditor, we are not applying this. We only apply this standard if the contract is with a customer. And we see a customer is a party to the contract that has obtained goods or services from the entity, and those goods and services are the output of the entity. That we say, or we refer to such people as a customer. For instance, I provide teaching services. If I've entered into a contract with anybody that I'm going to teach the person for this amount of years, this amount of months, my output Okay, the person is receiving these services, which are my outputs. So I can refer to that person as customer. A customer is a party that has obtained goods and services from an entity, and those goods and services are the outputs. So if you are an entity, what you are giving to a customer is not your output, that we say is not a contract. We cannot use IFRS 16. Please take note of all these. They are very, very important. You can be examined on the principles. Be examined on the principles. Now, let's dive more into the detailed principles of IFRS 15. In recognizing revenue, the standard prescribes 5-step approach in recognizing revenue. So we have 5 steps. If an entity wants to recognize revenue, the entity must follow all those 5 steps in recognizing revenue. And we are going to take each steps one by one, go into details what each steps is talking about. But because of the length of our video, we may take it step by step, or maybe we will combine step 1 and 2, then 2 and 3, and then we'll do 5 with other principles in the standard. All right. So 5 steps. So the standard prescribes 5-step approach, 5-step approach in recognizing revenue. In recognizing revenue. All right. So we have step number 1, which has to do with we identify the contracts. We identify the contracts. That is step 1. Step 2 is saying that we determine the separate performance obligation. So at the end of this lesson, we should be able to explain what is performance obligation. Then at step 3, they are saying that we should determine. So here, I think this is also identify. We should identify the separate performance obligation. Here, we are going to determine the transaction price, the consideration in the contract. That is step 3. Step 4, we are going to allocate the transaction price to the separate performance obligation. And I always say that step 4 depends on step 2. Whatever is happening at step 2 will affect step 4, because we are going to allocate our transaction price to our separate performance obligation. And then step 5, you are going to recognize revenue. You recognize revenue when? Or as performance obligation is satisfied. So this tells us that step 5 is saying that an entity cannot just stand up and then recognize revenue, because we are going to enter into a contract with the customer. Because you are going to enter into a contract with the customer, you just stand up, bang, and then recognize revenue. No, you only recognize revenue when you have satisfied the performance obligation, when you have provided the promised goods and services to the customer, when the control and the risk and rewards, ownership and legal title have been passed of those goods and services have been passed to the customer. That is the only when an entity is allowed to recognize revenue. And you look at what goes into step 5. We have when. Did you see the clause? It said when for us. That means we can satisfy the performance obligation over time at a point in time. So the standard prescribes these 5 steps for an entity to use in recognizing revenue. 5 steps for the entity to use in recognizing revenue. So we will take step 1 in this particular lesson. Step 1, we are supposed to identify the contract. Identify the contract. Remember, before we go to step 1, let me pass this practical example that contain all the steps. So I sell marker. Okay, assuming I sell marker, that is my day-to-day activity. I have entered into a contract with a party to provide 10 boxes of marker to the party. At the end of the day, the party, which is the customer, because my output here is my marker, I'm going to, provide 10 boxes of marker to the customer, get some consideration from the customer when I provide those 10 boxes. That is what we are looking at as revenue from contract with customers. Please bear in mind that your day in, day out activities, you are practicing IFRS 15. Most at times, you are acting as a customer or an entity to a customer. So, one way or the other, you are practicing IFRS 15 in your daily activity. I've been saying that one of the standards we do live by on our daily basis is IFRS 15. For that matter, it shouldn't be a difficult standard to comprehend and apply because one way or the other, we always practice it. All right. So let's now jump to step number 1. Step number 1 is saying that we should identify the contract. Now, in the identification of the contract, for us to say that there is a contract between an entity and a customer, the standard is saying that 5 criteria must be met. 5 criteria must be met, or 5 conditions must be present for us to say that there is truly a contract between a customer and then an entity. So I'm entering into a contract I'm the entity with a customer. Is there a presence, or is there all these 5 conditions, are they present in that contract? It is only when these conditions are present that we will say that there's a contract between the entity and the customer. The entity and the customer. Now let's look at the steps or the criteria. Please, this is not a step, this is the criteria, the condition. Okay, the condition that will warrant, that will prompt us that there is truly a contract between an entity and the customer. All right. Condition 1. The parties to the contract have approved the contract and are committed to perform their respective obligation. Until the parties to the contract have approved and are committed, they are all legally committed to perform their respective obligation. That is criterion 1 or condition 1. This condition must be present. The parties to the contract, they have what? They have approved the contract and are committed to perform their respective rights. Condition 2. The entity can identify each party's right. The entity can identify each party's right. That is step 2. So I know my rights. The customer also knows his or her rights. Condition 3. The entity can identify the payment terms. How are you going to pay for the goods that I'm providing to you, the promised goods and services I'm providing to you as a customer? How are you going to pay? Are you going to pay with cash? Are you going to pay with a non-monetary item? Are you going to pay on credit basis? Do you have the means to pay? The entity has identified the payment terms. 4. The contract must have commercial substance. The contract has a commercial substance. A contract entered into that does not have a commercial substance, that contract is not regarded or is not considered to be a contract to be accounted for under IFRS 15. Maybe we may apply a different standard. So the contract that we are looking at here should have a commercial substance. And when we see a contract has a commercial substance, we are saying that this contract should have the potential of affecting the risk, the timing, the amount of the future cash flows of the entity. The risk, the amount, the the uncertainty of the cash flows of the entity should be affected by this contract. If you say that contract really has a commercial substance, then it should influence our subsequent cash flow. And then the last criteria or the last condition has to do with the fact that it is probable that the entity will collect its consideration, and the entity will also, provide the promised goods and services to the customer. This step 5, in fact, don't let me use the word step. This condition 5 is very important to the extent that the entity must ascertain the credit worthiness of the customer because of this bankruptcy, because of untrustworthiness on the part of customers. The condition 5 is saying that it should be probable that the entity is going to collect its consideration. It should be probable. It should be 50% and above that. The goods I'm providing to you as a customer, I'll be able to collect the consideration from those goods I've submitted, I've provided. So, for us to say that there is truly a contract between an entity and a customer, remember that there must be what? There must be all these 5 conditions or criteria must be present. The parties must approve the contract and committed to perform their respective rights. 2, the entity can identify each party's rights. The payment terms can be identified. The contract has a commercial substance, and it is probable that the entity will collect its consideration. These 5 criteria must be present for us to say that truly there is a contract between entity A and then the customer. Now let's look at the next item, which is combination of contract. Combination of contract. We are still under step 1, combination of contract. There are some times where an entity will enter into a contract at or near the same time with the same customer or a related customer. Then the standard allows that you can combine such contracts and perform them as one. So, this is the entity here. This is the customer here. And we have entered into let's say this is contract 1. This is a separate contract. Instead of applying the provisions of the standard to account for this separately and account for these 2 separately, the standard allows that we can combine these 2 separate contracts and account for them as a single contract when 3 conditions are met, or when certain conditions in the question or in the contract are met. So you cannot just stand up and say that because I'm entering into the contract near or at the same time with the same customer, I can combine them and account for them as one. No. Some conditions must be present before we should be able to account or combine those contracts and account for them as a single contract. 3 conditions. 1, when the contract is negotiated with single performance objective. When the contract is negotiated with a single performance objective. So we are negotiating these 2 contracts, but these 2 contracts are going to be what? Perform. If the objective is to perform them with a single objective. 2, the second condition or criterion is that when the consideration of one contract depends on the performance of the other contract. When that is the case, then we have to combine the two. When the consideration of one depends on the performance of the other. Then the last one has to do with that when the contract, the contract can be performed as a single commercial obligation. The contract can be performed as a single performance obligation, not commercial, as a single performance obligation. So when these three conditions are present, then the entity is allowed to combine those two contracts and account for them as a single contract. Still at step one, there are some times where this contract that has been entered into with the entity, with the entity and then the customer, this contract may have other components, other contracts which are not within this standard, which is not a contract with a customer. So we are done with the combination. So we are looking at the next principle. We have entered into a contract, A to a customer. Okay. Now this contract, which is one aspect is IFRS 15. The other aspect is other standards. So this is just one standard, but it is having IFRS 15 components and other standards components. When this happens, the standard says that we should use if the other standard can be used to, measure, have the initial measurement and split the contract into this component, the other standard component, and the IFRS 15, then we go ahead and do that. But if there is no provisions on that, then we are going to use IFRS 15 to split the contract and then account for it. But there's a practical experience that although this contract is having two components, we may account for them as one. We may account for it as one under IFRS 15. Under IFRS 15. Now let's look at the last thing under step one. Let's look at the last thing under step one. Then we go to step number 2. The last thing under step 1. We call it contract modification. Contract modification. Contract modification. Contract modification. Now, anytime the scope of the contract, the promised goods and services, or the price, the consideration of the contract has changed, then it is giving rise to what we call contract modification. We have initially entered into a contract. The entity A and the customer have entered into a contract. Then subsequently, the scope, the promised goods and services has changed. The price of the contract has changed. That is what we call contract modification. Now, the standard says that anytime there's a contract modification, we must treat that contract modification as a separate contract, applying the 5 steps of recognizing revenue. That is one. The standard says that once there is a contract modification, there is increase in the scope of the contract, there is price or both, any one of them happening, and it's contract modification. And we account for that contract modification as a separate contract, as a separate contract, applying the 5 steps. However, there is an exception to this. There's an exception. The entity might choose not to account for a contract modification as a separate contract, if the following are happening. Now, the entity can, account for this contract modification as a new contract, when the promised goods and services of the existing contract is not the same as the new contract or as the new modification. So let's assume that the subject matter first was marker, but there's an increment in our scope, and now we are going to sell pen. You see, It's not the same. So here we are going to terminate the existing one and then treat this one as a new contract. That is what the standard says. But if the existing scope is the same as the new scope, then the entity is also allowed to treat it as continuation of the existing contract, the continuation of the existing contract. This is how we treat contract modification. First, it's either we treat it as a separate contract or we check if the new modification, bringing the contract modification is the same, the scope is the same as the previous one, then we treat it as what? Continuation of the existing contract. If not, then we treat it that we will terminate the old one, the existing contract, and treat the modification as a new contract. My dear learners, this is the end of step 1. So we have to go to step 2, where we identify the separate performance obligations. But as we always do, due to the length of the video, we will pause the step 1. We will pause our lesson on the step 1. And then in our subsequent lessons, we will start from the step 2 of how to recognize revenue from contracts with a customer. Please do not forget to subscribe. Do not forget to share our videos with your other colleagues, other students, other people going to write CA in the various countries, other individuals writing ACCA. This will be beneficial to them. Share with them so that we can increase our learning environment. We appreciate you, your time, for always learning with us. So, with RONAS, we are comprehending all the IFRS complications. Thank you.